Hi, good afternoon. So, welcome to my channel first. And this section, I'm going to give you some guidelines about the insurances and bonds. So, insurance and bonds are very important in a construction industry. It's something giving a safeguard to your employer. So, it's very important that as a quantity surveyor or a contract administrator, you should have a thorough knowledge about the types of bonds and insurances. So like in this session, what I'm going to do is like list out the major bonds which you're using in the construction industry and also insurances. Okay, so if talking about the bonds, I will start with the tender bond, the first, and the first bond for sure. So tender bond is basically a bond which a contractor is supposed to submit to employer during the time of tender. So when RFP, when an employer plot an RFP to the market or RFP to the contractor, he will mention contractor has to submit a tender bond along with his proposal. Sometimes it will be a percentage of the contract value. Sometimes they mention a fixed amount also. Sometimes some very minor percentage also. It's different, actually depends on the company strategies and stuff. The tender bond value is different. Why it's different? Again, there is a reason for that. So if you fix a 10 percentage of or 5 percentage or whatever the percentage of the contract value, so basically the contractor A, he going to a bank and he going to procure a, for example, in the tender you mentioned, tenderer has to submit 5 percentage of the contract price as tender bond. Okay, so 5 percentage. So when he go to the bank and he get a tender bond from this bank. Okay, so when contractor B also will go to same bank, maybe will go to same bank, and this contractor B will be a friend of bank or maybe having good relation with the bank. He will tell, like, there is one contractor, he procured a bond for this value, maybe your competitor just like. So there's a chance for those kind of malpractice. That's the reason always, like, it's not advisable to put a percentage actually. So nowadays, like, companies put a fixed value sometimes, to avoid such issues. So the main function of a tender bond is, like, so you submit a tender, and we as an employer, employer will be evaluating the tender and process and all, and you will be getting a LOA also. Okay, so as a contractor, you submit the proposal and employer is okay with the proposal, and he going to issue a LOA. But after getting LOA, you're thinking, like, no, I don't want this project, I don't want to work with this employer. In that point, employer has to redo the bidding process. Actually, he need to retender the process completely. So that cost which he going to incur due to retendering will be captured in tender bond. Okay, ideally tender bond will be valid till the issuance of a performance bond actually. So if you are a tenderer who submit the proposal and you got an LOA and you are the one who selected for the work, so until you submit the performance bond, this tender bond should be valid actually. Okay, so second one is obviously the performance bond. I think most of you should be aware of the performance bond. So performance bond is normally in practice, you see the practice is like 10 percentage. Even I have seen some countries like using 5 percentage of the accepted contract amount as a tender bond. I mean, it's when you tender the work, you have to define that what will be the performance bond percentage the contractor is supposed to submit. The function of performance bond, obviously, protect the employer from the performance. That means if the contractor is not working, is not performing well, if he is deviating his performance in some points, he putting employer in a bad shape, all these issues will be covered by the performance bond. So if you look into FEDIC clause number 4.2, which define the performance bond requirement, and it also defined under the FEDIC, like, which all condition employer can encash the bond actually. So because it's given by contractor to the employer to ensure the performance of the work. Okay, so if he is not performing, what other option employer had? He has to encash the bond. So there are some criteria which under the FDIC clause number 4.2, it's mentioned clearly the criteria as which employer can entitle or encash the performance bond. Basically, the function of performance bond is to ensure the performance of contractor. It should be valid till the insurance of performance certificate actually. So till that date, there should be a valid performance bond in place. So that going to protect your employment. If I'm an employer, that going to protect me from underperformance or breach of anything like that from the contractor. Okay, so we covered tender bond and performance bond. Now there is other bonds like advance payment bond. I think most of you must have aware of advance payment bond. When you enter into the contract, the first thing it will be like you are applying for the advance payment. So if advance payment to be paid, employer needs some guarantee. In the case if you are not repaying the advance payment, what will he do? For example, if bank giving you a loan, you will be submitting some sort of a payment certificate, your salary certificate, or sometimes you will submit your home that property stuffs and all. No, so basically you're giving an assurance to the bank like, see, I have this much property with me, or I'm getting this much salary, so I have the capacity to repay you. Same like that, if you want to get advance payment, you have to pay advance payment bond. So advance payment bond should be valid till the full amount is recovered. So if you pay 100 million to the contractor as an advance payment, the contractor is supposed to submit a bond of advance payment bond amounting to same amount. So when employer recover the full amount from his payment certificate, that advance bond will be released actually. And there is a practice, the contractor can reduce the advance payment bond. For example, the employer paid 10 million as advance payment to the contractor, and like within 5 months, already 5 million recovered. Then what he can do is like the balance is only 5 million to recover, right? So that he can reduce the advance payment bond to 10 million to 5 million, so that he will get extra facility from the bank in terms of financial support actually. So we cover tender bond, performance bond, advance payment bond, and there is one more bond which is called retention bond. Okay, you all know that when the contract we submit the payment certificate, there will be a recovery in terms of retention. Some percentage, could be 5%, could be 2%, could be 10%, whichever percentage agreed by the contract. When you enter into the contract, between employer and the contractor will decide this will be the percentage of retention. Just a heads up to all of you, we can't be generalized. In Middle East and region, and also in India, usually we put 10% as retention, but that can be changed. That can be changed to 5, 2 or 3, whatever. So what what employer and contractors agree, that's going to be the percentage. You can't tell like it going to be 10%. No, it's not like that. Whatever the percentage agreed between employer and the contractor, that is the percentage. The same is applicable for all the bonds, advance payment bond, performance bond, everything. But in case of advance payment bond, you have to put the whichever amount you're getting, you have to submit the bond for same amount. But other than those performance and retention, whatever the percentage agreed, that is the bond going to be. So as I'm going back, I'm circling around, sorry. So coming to retention bond. So retention bond usually is something, in payment certificate, from the gross amount, there will be two recoveries actually. One, a recovery amount for the advance payment, and one for the retention money. So the purpose of retention money is basically, that is an amount held with employer as a guarantee. So during DLP period, if you're not performing well, if you're not remedying the defect, this money will be using actually. So, but if contractor is facing some cash flow issue, and if he want those money early release, because retention money will be released in two steps. Okay, once you will get half of your retention money when TOC is issued, then you get second half of the retention money after performance certificate is issued, together with the final payment certificate. But if you want early money release, what you can do is like you will submit a retention bond, an unconditional bond to the employer. You mention like this is the retention money till held till date. Herewith I'm submitting the bond which is valid till TOC or performance certificate. So please release me my money. That will be helpful for me and also for the project. Since I am getting, if I'm an employer, I'm getting retention money, retention bond. Okay, if it's unconditional, I don't need to prove this also, so I'll be happy. But again, nothing is equal to physical money, so it depends on the company, like whether you want to release or not. It's completely depends on the company to company. So now we discuss like tender bond, advance payment bond, performance bond, retention bond. So these are the major bonds which we are using in the construction industry, as which perform the core function, like ensure performance, ensure tender commitment, and advance payment recovery and retention recovery. So these are major bonds insurance. Hope you guys are clear with what I'm explained. If you have any further question, you can pause me. I'm happy to answer. Okay, so my intention was actually cover both insurance and also performance bond, insurance and bonds together. So I'm moving to second section of my section, which is insurance. Okay, insurance is basically a safeguardness. Actually, it's covering the risk. The main function of insurance, obviously, there is a risk that you're going to cover with insurance. For in a common, like in our day-to-day life, we are driving a car, and when we drive the car, there is a potential chance for the accident, which you cover by the insurance. Yeah, so which like and we as a human being, we also taking some insurance for the health, which is health insurance. Same way for the construction also, we taking insurances. Before explain the insurances, let me tell you there is two type of insurance. Okay, one is owner procured insurance, the second one is contractor procured insurance. So when before tendering, before like if I am an employer, I will decide the strategy who going to procure insurance, whether as an employer I am going to procure insurance or the contractor going to procure insurances. If I am going to procure insurance, I will mention in the tender like, guys, dear contractor, the insurance model is owner procured, so I am going to procure my insurances. Okay, so you don't need to consider that elements to your bidding. And if employer don't want to take such headaches, what he will do is like, contractor, you procure the insurance. Okay, so basically this is how the insurance work. So the first insurance, obviously the car insurance, contractor all risks insurance. It can be procured by the employer and also by the contractor. So depends on what we agreed is the strategy. It will be procured by contractor or maybe by the employer. So car insurance, like CAR, contractor all risks insurance. Okay, it will be covering contractor all risk actually inside the premises. Okay, so the permanent work will be covered, the equipment's plans will be covered. Depends on what all provisions are included in the car insurance. I have seen car insurance which covering work plus planned equipments, and I have even seen some insurance covering only car, like work only, not the equipment and plans. That depends on the insurances and agreement. So but ideally the car insurances should cover the permanent work and the planned equipment. And so if the car is not in place, so there's only the work is being covered in the car insurance, the first scenario. And now you have to procure the planned equipment insurance separately. So work insurance, the permanent work insurance covered under the car, and planned equipment you supposed to purchase. Planned equipment insurance is something like all the planned equipment whichever you're using inside the site should be covered, not the planned equipment part of the permanent work. For example, chillers, generators, all those stuff will be covered car insurance, but the tower crane, any hoist, like any such equipments, that will be covered in plan, and even vehicles that will be covered in the plan insurance. Okay, so then again, workman compensation insurance is like whoever working in the project should be insured, because if some potential hazard happened or risk happened, it should be covered somehow. So there is called workman compensation insurance. Okay, again, some other insurance called employer liability insurance. This is usually taken over and above the workman compensation. So this the main function of employer liability insurance is actually to prevent a third party comment, a third party claim, actually, my bad. So if you just imagine, like, if you have a your employer and a contractor working under you, okay, and some risk or accident happened, and an employee of the contractor faced a lethal issue, or he dead even, okay, he dead, then this employee's family complained or filing a case against you as an employer, telling like this, he was working for your project, so you are liable to pay. So this kind of claims can be prevented or covered through employer liability insurance. Then there is third party insurance. Third party property insurance is there, which is covering the third party and other properties, because due to your project there is chances like some other third party can be insured, or a potential damage can be caused to third party or property, that will be covered through the third party insurance. Okay, so there is something called property all risks insurance, PAR, which is taken for the full property to cover, actually. And so car is the planned equipment I covered, employer liability, workman compensation, employer risk insurance is that is something very important. Employer risk insurance, basically, if you look into clause number 18, you can see some employer risk. I'm talking about FIDIC perspective, FIDIC 99. If you go to clause number 18, you can see some employer risk. So employer may ask like to contractor, I want these risks to be covered through insurance. So those risks you can cover through insurance, actually. There will be premium, but again, that will be covered. Especially if you ask me like some 18 point under 18.2, it's like there was point like G, F, H, it should be covered. It's best to cover, actually. Okay, so you will have there is, well, already the risk is defined, and if you can cover those, it fair enough. And again, in car insurance, there's always provision to endorse additional items, actually. This all depends. So whatever I have explained is basically the main type of insurance, and that usually used in the construction industry, and the premium and coverage all depends what you agree between the company and the contractor, actually. So for the majority of the employer, there will be a insurance consultant, because why, being a contract manager or a commercial manager or a quantity surveyor, we will not have much expertise in the insurance part. Okay, we know overall, but if you want to go deep into those things, we might not be know. So what we will do is like we will appoint a consultant for the insurance, so they will give the best guidelines, like what kind of insurance, what should be the coverage required, what all to be covered. So there is usually the practice like we'll appoint a consultant for that, and he will advise like insurance requirement. So there is one more insurance which I forgot to mention. It's called PII insurance, professional indemnity insurance. Actually, the main purpose of this insurance is like if you're doing any design, because of design, employer facing some issue, and the employer claimed a huge amount against the consultant, that will be covered in the PI insurance, actually. So even if contractor doing any design portion, he has to submit the PI insurance, actually. The coverage and amount, that's purely depends on the project to project, actually, and that is to be decided based on the project. And just one more thing which you should be very careful when you're reviewing the insurance. Let me just tell you how you review insurance in a very comprehensive way. Like obviously you have to check the validity of insurance, how long the insurance is going to cover, and the amount which is covered. Deductible should be checked, and what all the exclusion, what are the clauses, special condition, that should be checked. And if there is any perils are covered, that should be checked. And there is one more clause which is very important, subrogation clause, that you have to check thoroughly. Okay, when you get a insurance to review, first thing just ensure like there is a waiver of subrogation. If no waiver of subrogation, that going to backfire you in some point. For example, so as an employer I'm telling some changes, because of those change, if something happened and if subrogation clause is not waived, that going to backfire. So subrogation clause basically giving a right to insurance company to sue the party who caused the defect. So let me explain one more thing. If I am an employer, I took the insurance, but still if I made a mistake, insurance party will sue you. That is subrogation clause. So you have to ensure, take out those clause. Okay. And if different contractors and consultants are covered in a single car policy, please ensure there is a cross liability clause, because cross liability clause ensure like only those the particular portion which is allocated to the contractor is only covered, and under this particular clause each entity will be treated as a separate company, and there will be separate claim process will be there. Okay, so this is all about like about bonds and insurances. I hope you're clear with something, clear with the topic, and if you have further comment, please post. I am happy to answer. Thank you.